Hello everyone, welcome back. I know it's been a while since I've uploaded videos on YouTube. I wanted to say that I still do my iron condors 8th of September. That's the most recent expiry. So I closed my positions on the 30th of August. You can see this is my Twitter. So I closed my positions on the 30th itself because I was not very happy with the risk reward for that day. So if you go back to that day, you can see here that that day was just like it's a crazy, one of the most craziest up moves for about like 300 400 point, just one way move with only a couple of red candles in 15 minutes. So I closed it here. So I closed it in the morning at like, you can see here on the 30th, right? I closed it at like 10:30 and I initiated my next week's at 3:28 at the absolute end of the day. Why? Because I wasn't sure where the market would do. So if I look at this, right, before initiating, we always look for this would be my resistance, this would be my support. But because of this huge buying pressure, there was more, the call premiums were also higher because the risk upside is also higher. So what I did was, this is my CE sell and this was my PE sell. Alright, so this was my range 18 to 17 to 50. I had sold 18 to 50 call and I had sold 17 to 50 call. So that was my range. So if I go back, we write it down clearly. So what I did was, I had on the 30th, 38, I had sold 18 to 50 call and I had sold 17 to 50 put. So my range was 1000 points. 1000 points is a decently wide range. Now how much did I sell this? And then I would have bought 300 point hedge. 18,550 call I would have bought and 16,950 put I would have bought. So 18,250 I had sold for 35 rupees and I bought this for 12. I had sold this for 40 rupees and bought this for 19 rupees. So overall there was about like 20 to 25 rupees in each one. Right? Next, let's figure out what the markets did after that. So this was the huge buying pressure on that day. I initiated my iron condor at somewhat around like at the end, right, like 3:30, and see I initiated my my iron condors at 3:28 at the end. It was 17,300 and 17,000. Sorry, okay, let me write that down. 17,300 and 17,000. P side 17,300 PE and bought 17,000 PE. This was trading at 40, this was 19, so about like 20 to 25 rupees on both sides. Now let's look at what happened for the market after next day. Next day there was a huge gap down. Okay, huge gap down, and it came up to about 17,500. So my initial thoughts are that my CE would definitely decay like crazy. My PE would have shot up. But because my CE had quite high value because of the move, delta move, because of all of this move, CE was at risk. So the value was very high, immediately decayed quite a bit. My initial idea was, when there is a gap down, right? When there is a gap down, this is price action. When there is a gap down, there are three obvious things, right? One is to fill, go up. The other is to sustain, right? The other is fall more. Like, think about it. When it falls down, that is my biggest problem, because now my PEs are inflated. I want it to either sustain or go up, right? If it does these two, I am happy. If it does this, then I need to manage. So that is one thing that I would suggest to everyone. Figure out where is the problem. Don't adjust just because you need to adjust. So my idea was, when the 15-minute candle was green, I would only adjust if it broke the 15-minute candle low. If it did not break the 15-minute candle low, I would not have adjusted. Okay. So now, when this had happened, if I continue on, it moved up, came back, closed. So it closed somewhere here. So I had absolutely nothing to do. If you look at my trade book, on the first, I had no trades. Why? Because the market was doing what it wanted it to do. There was no need to adjust. There's no need to bring my CE down, nothing, because I'm worried about my PE. When the market goes up, PE would also have decayed, so would have been no issues. So I refrained from making as many making a lot of adjustments. So next day, all right, the market opens flat, like 20-30 point, and then it comes down, and then it stops here, and then keeps going, keeps doing this. And then this is where the market closes. The moment the market, I always try to refrain again from adjustments until the very end. So when it was about like 3 o'clock, I realized that the biggest problem is going to be my PE, right? My PE is 17,250, right? So if I zoom out, my PE is 17,300. My C is way up, it's quite low. So my idea here is that I have to worry about my PE, not about my CE as much. So what I do, I roll down my CE. When on the second, so this is what I start to do. So on the second now, 2.9 is when I closed this, right? Closed at a profit. I bought it for 35 and 12. I closed it for 4.65 and 1.7. It was almost a profit of, it was almost quite a good profit of about like maybe like 17-18 points. Now one thing I have to mention is something I do regarding position sizing. So let's say I have about 1,000 quantity that I want to initiate. I would do half on one day and half 1x on the other day. Why? Because this helps me average out. If I close it on a Thursday, then 1x I will do on Thursday, next one I will do on a Friday. If the market is very volatile, like we saw in like early August, or even in July, the Monday it was just gapping down. It would just gap down like 200 points or gap up. At that point, I initiated it on Friday, and I would initiate the second lot on Monday. So far I have only initiated 1x of what I had, or half of what I wanted. On Friday I closed half of it, okay, and I opened my full quantity 17,950 CE. Okay, I opened it at 25 rupees. That was what I sold it at. The next one was I added another 1x. The market had come down, right? So I added 1x, 17,000 put. So I had 2x 17,950 and 1x 17,300 and 1x 17,000. That was my overnight thing on the second of second. So because why? I was worried that this is a Friday. If the market gaps up, my PE will take care. But if my market gaps down, I will have to close my 17,300. I will keep my 17,000 open. That was my idea. Monday, market flat, opened flat, and as time went on, I was looking for a swing high or a swing low. This is my swing high. It got broken here. This is my swing low then. This is my swing high. My swing low was not breached, and it made another. Market looked like it was going up. So at this point, okay, this is on the 5th, right? On the 5th, what was I worried about? The market was bullish, so I was worried about 17,950. So what I did for 17,950 was I closed 1x 17,950 and I covered it at 32. I had 7 rupees loss. So if you know on 22nd I closed this at profit. The profit was about 8,000 rupees. On 5th I closed my 17,950 1x and I lost about 4,500 rupees. I booked a loss. I'll show this also. I had booked a loss and I opened 18,050 CE. I closed 1x this and I opened 1x of this. So at the end of Monday, what was my position? 1x of this remaining 17,950, 1x 13,850 and this one. Now on 5th, when the market started going up, I closed this one for a profit, right? Closed this one for a small profit, and I had opened 1x 17250 PEE. This is one more thing, so I will just put on the points. Position sizing, I split my positions. These are my important takeaways. Second is close half quantity and reduce risk. Right, close half my quantity and reduce risk. The one more thing that was there is minimize adjustment. Right, these are the three things that so far the key takeaways for you. So at this point I had 1x 17250 and whatever remaining 1x 17300 P. This was my position on Monday afternoon because I had closed this one, right? So I closed this one, I closed this one, and of course I closed this one earlier. So these were all my positions on Monday evening. Monday, why was I was a bit more bit less careful because Monday evening was a US market holiday, so I knew that there would not be too much effect from the US global market. So 8,000 on the second and minus 4,500 on the Friday. Let me show that also to you. So 8,000 was from my 8,000 plus was from my call profit. This is my call loss because I had rolled back. Why? Because the market had positive momentum, so I didn't want to take a chance. So this is what I had on Monday. Tuesday, let's look at what the markets did. On Tuesday, the markets opened a little bit higher. Again, it was still going down. It broke the swing high. I was waiting for the day's low to be broken. It never broke the day's low. It didn't break the day's high also. So at this point at 3 o'clock, I'm looking at the markets and I'm thinking, okay, it looks like the market doesn't have as much. The fear again is on the lower side. Why? Because the markets didn't, it is neutral actually, I would say, because the markets didn't break upside, it didn't break the downside also. So what I did, to be safe, because the US markets are opening after 3 days, right? To be safe, what I did this was on the 6th, 6/9, primarily what I did was, I had closed upside, you can adjust, downside is very difficult. So I closed this again for a profit and I opened 17,850 call, right? And I made this 17,850. Now this day, because of this, I actually closed this one and 17,850. This I rolled down to 17,900 call. I rolled down each 50, 100 points, right? So I closed this down for a profit on 6/9. This is my profit, 5,400. I'll show this one also to you. So this, on Tuesday, I rolled down my calls and I kept my puts the same. My puts are still the same. These are still the same. I'll show my profits. So I had gained about 5,400 that day. What did I do? I just rolled. But so now I was worried about markets. Markets could easily open here, or it could easily open here, because Monday global cues and everything would have just added up 3 days of US always. So what I did was, I wanted to protect from 1% moves, right? 1% moves. So what I did was, I added some ratio spreads. That is my third idea that we need to discuss, or the fourth, ratio spread, right? So what is a ratio spread? I was worried my calls were at 17,200, like 17,250 and 300, and my puts were at my puts were at 17,200. My calls were at 17,850. What if it goes up? So what I did was, to provide protection here, I did a ratio spread. I bought 17,400 one quantity. Actually, I bought 100, I believe, of 17,400, and I sold 200 of 17,300. Again, I bought 17,700 100 and I sold 200 of 17,850. So this way I did pay a penalty. I think my profit would have reduced by at least 4,000 rupees or something, but I had protection. I paid 4,000 rupees for protection, right? So now, given all of this, how did my iron condor look on Tuesday? This is how it looked on a Tuesday. Okay. So I had closed some of my hedges. This is somewhere during market time. So I had closed some of my additional hedges. So this is how my iron condor looks. If the market gaps up, my buy will give me protection. If the market just doesn't do anything, then my sell will give me protection, but my profit is lower. Okay, my profit is low. So this is what happened on next day. The market gapped down a little bit, but there was no big issue because my 17,400 put would have given me a little bit of profit. And finally, when the market breached this, market breached this high, I did not want to actually take more risks. I had already made my 2.5% for this week, and so what I did was at 11 something I closed it for the remaining money. You can see here, so I closed this for 20,000. So this was 8,000, 5,000, so this is 8,000, 5,000, it's about 13, 14,000. 14,000 minus 4,000 is 10. 10 plus 20 is 30,000. So together, 31st to 7th, I took 29.6 thousand, which is about 2.5% of what I had used. So normally I use about 10 lakhs margin, but because of the ratio spread, my margin increased, and I keep 1 to 2 lakhs for adjustments. So yeah, that is the story of how the iron condor this week came in. So all right, okay, take care everyone. Happy trading. Of course, if you have any comments or doubts, please write down, and if you like this video, do give it a like. All right, take care, bye.